Hey, what's up? Austin the Money here. What a day. What a meeting. Jerome Powell, very, very dovish, hinting at that September rate cut that the market has been looking for. So we got that rebound. We've been selling off all week because the market has started to price in maybe we might not get that third rate cut, all three rate cuts this year. But he signaled that September is pretty much it's pretty certain that we're going to get that cut in September. So the market has immediately started pricing that in. And we are up 1.5% on the NASDAQ and 1.5% on the S&P 500. And the Dow Jones actually the outperformer. So tech was not even leading this market rally. It was more defensive sectors, which is kind of surprising. Also to note, the volatility index is at its lowest point of the year. Hasn't been this low since you go over here to December 16th, December 13th, December 16th of last year. So this is like very, very optimistic. This is greed, and that's great. Everything's going great for the short term. But let's go over some things on possible risk, right? So Jerome Powell had his meeting on July 31st before this whole job revision got revised down, and they decided to hold rates. Well, this came out the very next day, all right? May went from 125,000 revised down to 19,000. That's over 100,000 gone. June went from 147 down to 14K. So combined, that was almost 258,000 jobs lost that just disappeared out of nowhere, which is crazy. And then July came in at 73. So he's going to talk about, this is basically why he is leaning towards cutting rates, right? This is very weak jobs, and he's going to let you know basically that, if things start to escalate and get bad, they happen fast. This isn't something that takes its time. The job market can get bad, and it gets bad fast. And then going over inflation, why he's not too concerned. He thinks it's going to be more of a one-time thing. But let's go ahead and get into this first video. This is basically why he's leaning towards the cuts. Basically that the job revision has had, multiple bad ports in a row.
The July employment report, released earlier this month, showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months, down from 168,000 per month during 2024. This slowdown is much larger than assessed just a month ago, as the earlier figures for May and June were revised down substantially. But it does not appear that the slowdown in job growth has opened up a large margin of slack in the labor market, an outcome we want to avoid. The unemployment rate.
All right, so that was basically him saying the average of the last 3 months is 35,000, which if you take these, it's somewhere around that 35,000 mark. So, this wasn't there when they made their decision last time, and he's taking this very seriously in the future meeting, which to battle this, you cut rates. So that is very dovish, cutting rates, very bullish for the economy. That's good. As long as this doesn't get out of hand, that's very bullish. So let's go into where he talks about the labor market, the labor market risk, and basically the risk of all this.
While the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. At the same time, GDP growth has slowed notably in the first half of this year to a pace of 1.2%, roughly half the 2.5% pace in 2024. The decline in growth has largely reflected a slowdown in consumer spending. As with the labor market, some of the slowing in GDP likely reflects slower growth of supply or potential output.
An agile supply team already by your...
So he's basically saying that, what am I trying to get at here? He's trying to say that there are still risks, and if it happens, it can happen badly, and it happens really, really fast. So that's just why he's kind of cutting rates early. He wants to get ahead of the game because we've already have 3 months of bad data, and he did not know that until August 1st. So that means he could possibly be a little bit late because that data came out so late. But he's taking action now. He wants to get ahead of this just in case that this labor market keeps going down. He wants to basically jump ahead of it. So that is signaling, high certainty for a September rate cut to battle this job market. All right, now I want to get into the inflation and basically why he's not too concerned with inflation right now. I do have some comments to say on this as well, but let's get into this clip.
Are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level.
So he believes, this is his base case, that it's a one-time price hike and it'll be short-lived. Now, obviously, he has said this in the past. He also assumed this in 2021. He thought inflation was going to be short-lived, it was going to be transitory, and we were going to go back to, lower inflation. And that was actually not the case. Inflation kept rising. Everybody that said, which was 90% of people were saying that this was going to be very short-lived and transitory, they were all wrong. So I'm not saying he's going to be wrong this time. I'm just saying that there is that possible risk. But you're going to need to see, at least 4 to 5 months of data to see if it is this one-time thing that he is talking about.
Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. It's also possible, however, that the upward pressure on prices from tariffs could spur a more lasting inflation dynamic, and that is a risk to be assessed and managed.
So he said it could come at one time, but not all at once. So that just means he's going to need to see, probably about 2 to 3 months of inflation data and basically hope that it's, kind of flat, maybe slightly elevated. But obviously by like month 4, 5, or 6, if inflation is not going down and it's showing to be longer lasting, then he's going to have to combat it, which means keep rates same or possibly hike. So if this is a one-time thing and inflation is just kind of going to rise for let's just say 2 to 4 months max, and then we trickle down, very, very bullish on the economy, very, very bullish. But if not, then I would start to think, defensive sectors and all that. So honestly, I think we could be in a bull market. After seeing this, I think we could possibly be in a bull market for the next 3, possibly 4 months, at least until we see if inflation is lingering or not. If it's short-lived, then, we're going to be going great. If it's long-lived, then we're going to have to start battling that, and that could come with higher interest rates. So basically, Jerome Powell is more focused on the job market right now because he's had 3 reports in a row showing bad job data. We've only had 1 inflation report in a row showing bad inflation. So obviously, 3 reports in a row is going to outweigh 1 report in a row, because this 1 report could be short-lived. This job data is showing 3 months in a row, so it's lingering, and that's not good. So he's taking care of the problem that's been here the longest, and that is the job market. So I would definitely look for that rate cut in September. And then I'm going to highlight one more clip, him basically talking about how in 2020 he thought it was going to be short-lived inflation, and it was not. Basically him admitting that, he could possibly be wrong about this inflation as well.
Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem. So, Putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation.
And that right there is the being pulled in both directions I was telling you about, right? He just exactly explained that. So job market is going down and inflation is going up. It's very difficult to be in a place like that, but since the job market has been going on longer, then he's going to tackle that problem first. But exactly being pulled in two directions.
Or monetary policy. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside.
Boom.
A challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate.
Which is not easy.
Our policy rate is now 100 basis points closer to neutral than it was a year ago. And the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach.
So he's basically just saying this is his base case for inflation right now. Obviously, they go by the data. Every single month, new data is coming out. And if their base case needs to change, then it will change. But they will tackle the problem if inflation lingers on. He basically is saying, like, he is not going to let that get out of hand again like he did before. And I'm sorry, I have one more clip to show you. I think this is the last one right here. Well, after this advertisement. This is him talking about the
inflation and the ELB. The post-pandemic reopening brought the highest inflation in 40 years to economies around the world. Like most other central banks and private sector analysts, through year-end 2021, we thought that inflation would subside fairly quickly without a sharp tightening in our policy stance, as this slide will show. When it became clear this was not the case, we responded forcefully, raising our policy rate by 5.25 percentage points.
So when he realized that it was not transitory, he forcefully raised the policy
over 16 months
by 5.25% in 16 months, which if you guys have been invested in all of late 2021 and all of 2022, you guys felt that pain. I know I felt the pain. It was a very bad year. But if you look at since January 2023 till now, we're coming off back-to-back years of the S&P 500 being up 20% plus. All right, we can't expect to keep having these crazy years in a row. All right, we're probably going to see some downturn, maybe a little dip, but honestly, I don't really see us getting any more than like 5 to 10% max of a dip right now. I think if there's any dips in this market short term, they will probably be bought up. But basically, be bullish, but also just be on the watch for the new inflation data that's coming out, right? Because right here, companies are already passing down the tariffs to their consumers, all right? So examples of companies raising prices: Adidas, Walmart, Home Depot, and Target. These are basically raising their prices in response to tariffs, right? So when they get passed down to the consumer, that's what raises CPI, Consumer Price Index. So PPI comes out hot first, then probably like 2 months later, your CPI, if companies pass it down to the consumer, that's where that price starts getting hiked up. So that's going to really hurt your lower income people that are already struggling. Now they're going to basically get, either if they want the same stuff, they're going to have to pay more money, or they're going to have to put stuff back on the shelves because they can't afford it, which is a very unfortunate spot to be in. But this is the price of tariffs for some companies. Walmart, Home Depot, Target, and Adidas, they're already doing that. And we haven't even really seen the true effects of tariffs yet. So nobody knows what to expect. But just know some companies are raising prices, because if they don't, their profit margins are going to go down, right here, they're protecting their profit margins. If Walmart takes, I don't know, let's just say a 5% hit on tariffs and chooses not to pass it down to the consumer, when they drop that next earnings report, they're going to be telling, hey, our profit margins just took a big hit. We're less profitable now, and their stock's going to tank. And they don't want their company to tank. They'd rather just raise prices, especially Walmart. Walmart knows people are going to go there. Like, they could raise prices and people are still going to be shopping at Walmart. Walmart's everywhere. And, yeah, people will always go to Walmart because generally they are lower than most grocery stores. Just how it is. But at the end of the day, we are very, very bullish. Huge rebound from being down all week. We pretty much have seen this little sell-off all week, and we've rebounded. And to be honest, we've kind of just rebounded what we lost. So everyone was nervous this week, and then Friday we pretty much just gained it all back. I mean, we didn't even really like break out. We kind of just got back what we lost Monday, Tuesday, Wednesday, Thursday. So pretty bullish meeting. Definitely the VIX could get lower. I'm not a buyer when the VIX is this low. I'm a buyer when the VIX is above 20, definitely above 30 and above, right? So I will still be trading. I'll still be doing my weekly trades. If we do get a nice VIX pop, which means stock market's going to dip, I might buy some long-term shares because I do want to start taking advantage of long-term capital gains. That is definitely something I need to be taking more seriously for tax purposes. So I will be showing you guys basically some long-term shares that I'll be getting into whenever we start seeing market dips. And I do have a Roth IRA in my Robinhood that, let me see if I can pull it up. It is a small account. All right, so how do we even get there? I don't even know how to get there. Maybe retirement. Here we go. All right, so I have a small account in the Roth. I just made it not too long ago. I've contributed a little over $2,400, and we're actually killing it. We were up over 70%, but then I added $1,000 into it, so it basically brought my percentage down. But we're already up $1,000 this year, almost 44%. I do plan on maxing this out this year, but if you guys want to follow along with my small account, because obviously not everyone's going to have, 6-figure, 7-figure portfolios. But I will be getting into this small portfolio of my Roth IRA and getting into some trades there as well. So I hope you guys look forward to that. If you've made it this far, I appreciate you so much. And drop comments down below. Let me know what you guys are thinking about the market, thinking about what Jerome Powell's doing, inflation, and all that. And how much money have you guys made this week? Let me know. All right. See you guys in the next one. Peace.